So good afternoon, everyone. It's 2:03 on my end. Out of respect for everyone's time, we're going to start. Once again, good afternoon, welcome, and thank you for joining the Business Outreach Center, BOC Network, today for our webinar on top 10 uh, tax tips for small business owners. Just to share, my name is Damaris Burgess. I represent the Bronx BOC office, the Bronx BOC office, located on 1231 Lafayette Street on the second floor, located on 1231 Lafayette Street on the second floor in the Hunts Point section of the Bronx. Um, Once again, my name is Damaris Burgess. I serve as the director of the Women's Business Center. We're so excited to have you join us today. We look forward to working to support you in any business development endeavor that you may have. Um, to share with you just a little bit more about the Business Outreach Center, we put together 4 quick slides, and then without further ado, we will introduce Mr. Paul Rosenblum with Numerix Services. Paul, did I get that right?
Yes, you did. Thank you.
Fantastic. Thank you so much, Paul, for being with us today.
You're very welcome. Thank you for having me.
Absolutely. So just to share, the Business Outreach Center Network mission is to improve the economic prospects of traditionally underserved groups with a focus on low and moderate income entrepreneurs and the communities, and thereby create genuinely brighter futures. The Women's Business Center is a program. The Women's Business Center is a program of the Business Outreach Center Network, which is a nonprofit organization. The Women's Business Center program is powered and funded partially by the Small Business Administration. The Small Business Administration Women's Business Center's mission is to enable and empower women and entrepreneurs through advocacy, outreach, education, and support. Again, although we do focus this particular program on serving women entrepreneurs, we serve anyone. So thank you again, regardless of your gender, for joining us today. If you see here, we have offices located in the Bronx, once again, Hunts Point section of the Bronx, 1231 Lafayette Street, with a satellite location in Upper Manhattan. We also have our location in Brooklyn, downtown Brooklyn, on 85 South Oxford Street. We also have a Queens location, as well as a Staten Island, satellite office. Again, through the Business Outreach Center, we operate many programs. So if you're interested in learning a little bit more in depth about our programs, please feel free to reach out to me. And I will be emailing you all after this workshop with some important information, as well as a survey link. Surveys are very important for us at the Business Outreach Center because we value your feedback. It's important for us to know what you thought of our presentation today, and if we can request as a follow-up after this workshop for you to complete the survey, we would greatly appreciate it. So once again, we have multiple locations, and if you're interested in learning a little bit more, once we email you, I email you after this presentation, you could just send me a quick email back and we'll schedule a one-on-one business consultation orientation. In sum, these are some of the high-level programming that we offer at the Women's Business Center: one-on-one business counseling, workshops and training, such as this one today, child care business development. Jeannie, are you here? Can you hear me?
Yes, Damari, I'm here.
So Jeannie is the director of the Child Care Business Development Program. If you're interested in taking some training and opening up a child daycare, Jeannie can support you with that. Jeannie, thank you so much for joining us today. We also have a program. Yeah, absolutely. We also have a worker-owned cooperative business development initiative, some COVID-related workshops and training, mentorship programs. Again, BOC Capital. BOC Capital is our lending arm, a community development financial institution. So if you're interested in learning of some of our financing resources, products and services, once again, feel free to reach out to me. I will email you after this webinar. We also help entrepreneurs become certified as a minority business through the city and state. We can support you with fast tracking that application. If you're unfamiliar with what a minority certification is, more reason to reach out to us, me directly, schedule a one-on-one, and we can go over that with you. We also have a BXL Business Incubator. If you're interested in having office space in our incubator, I can send you that information as well. And we also have many collaborative initiatives to support business owners. So once again, thank you so much for being here today. And without further ado, Mr. Paul Rosenblum with Numeric Services.
Thank you very much. And I'm going to share my screen.
Okay, I just stopped the share.
Okay, let me try it again.
Oh, sorry about that.
Okay, is this a full screen? I just want to make sure that it's in the right mode.
Yes.
Good, great. Okay, so thank you again. Let me introduce myself, and then we're going to get right into this because it's really a lot of information in a couple of hours. My name is Paul Rosenblum. I have been a bookkeeper for about 25 years. And at the very beginning, when I started a company back in 1995, I pretty quickly kind of stumbled into teaching QuickBooks. Didn't even know what QuickBooks was. I got a call from the school that got my name from somewhere, and they wanted me to do a 2-hour training session. And they gave me a QuickBooks cheat sheet and said, well, you know bookkeeping. I understand you're very good. Just, I'll give you a couple of hours. They're coming at 2:00. And this was noontime. And so I crammed for it. And that was my first teaching job. And ever since, I've done a lot of teaching, kind of took a step back from the bookkeeping for a while. Then the bookkeeping got busier and busier. And all of a sudden it's 25 years later and I have a full-time bookkeeping practice. I have about 130 clients that I'm responsible for the bookkeeping or working with their bookkeeper. I do have some people working for me, but I still end up doing most of the work. And I love teaching. Teaching is probably about 20% of the time for me, but I have passion not only for bookkeeping, but I have passion for teaching, and I have passion for the accounting and the tax parts of accounting. So this is kind of how I've come up with this particular presentation. A lot of people were asking, there's no real way of just getting a list of things to look at when it's tax time and when you have to get things together and and put together a set of books. So I'm going to talk to you today as a bookkeeper, but I'm also going to talk to you today as almost an accountant, even though I'm not one, because I have a lot of tax knowledge for small business accounting, because I've been very lucky. A lot of people have a couple of different accountants have kind of let me into their head, and in some cases they have let me into their computers, so that when we are putting together taxes for the small business for my client who I share with a particular accountant, he has let me log into his tax software so I can see exactly what he's doing. And I've done that for years. We do things like depreciation together. So I have a good relationship with a couple of accountants who say to me, well, let me log into your computer. We'll do this together. You don't have to send me the books and then never hear from me again. So this is where I get some of my accounting knowledge and tax knowledge. So I'm going to try to put the three of them together today. We'll talk about a lot of things. These are really 10 things that I think are important at tax time in not really any particular order. So don't look at number one as the most important and number two is a little bit less. They can be, any order that you want. I think they're all equally as important. So let's start with the very first one. I can't tell you how many times I start with a new client and I talk to them on the phone, or I used to talk to them in person. Now I'm talking to them on Zoom. And one of the first questions that I ask is, what kind of entity is your company? And they say, oh, I'm a corporation, because I guess they're proud to say that they're a corporation. And then I take them on as a client, and I find when they send me a first bank statement, I find that they're a sole proprietorship or they're an LLC, which does make the bookkeeping and it makes the taxes different, different forms, taxes wise, and just different ways of doing the bookkeeping. So the first number one for me in this presentation today is knowing the kind of entity you are. And on the top of this slide, I have a brief explanation on what the five groups are. Group number one would be what we call a sole prop or a sole proprietorship. This is you as an individual doing business as another name. So you can be Jane Doe doing business as ABC Company. And ABC Company can be on your business cards, and then that's your company. If you do that, you are considered a sole proprietorship, and all of that is part of your regular April 15 taxes that you've been doing for years. Even though you think of yourself as a business, and you're a separate entity called a sole proprietorship, the IRS does not recognize sole props as a completely separate entity. So it's one form called the Schedule C that's part of your taxes. Everything else is attached to the 1040. Then we have the second group, an LLC. An LLC is not a limited liability corporation. It's a limited liability company. It is a non-corporation. Again, the IRS does not recognize LLCs as a separate entity, but many, many, many states do. In New York, where I am, LLCs have their own filing fees. You pay New York City taxes called unincorporated business taxes if you make over a certain amount of money. And you also, if you're a single member LLC, you will pay the IRS through your personal name. The actual company is not recognized as a separate entity by the IRS. There's another kind of LLC that is called a multi-member LLC. Multi-member LLCs is if you have two or more owners actually on the paperwork as owners, or you can have one owner of an LLC, but then you can have investors buying value into your or investing money for value in your particular LLC, and that's called a multi-member LLC, or another word for that would be a partnership. And partnerships, the due dates are different, the tax forms are different, and the bookkeeping is different. Then we have another category that you may have seen some lawyers do, and they're called LLPs, limited liability partnerships, where you have two or more owners of a company, not necessarily any investors, although you could, but an LLP is actually a partnership. It's a little bit different than a multi-member LLC. The corporations, we have two kinds of corporation. We have an S corporation, which you can kind of think of that as one step above an LLC. An S corporation is a completely different entity. It has a different due date. And you have to do, being an owner of your S corporation, you are also an employee of your own corporation. So the corporation pays you payroll. And then you have personal taxes, and part of those personal taxes is the net profit of the corporation. So all of these things are really complicated, and that's all I'm going to talk about how they work for today's presentation. But C corporations, think of Microsoft, think of big, big, big companies that are completely separate, not part of anyone's personal life at all. So it's a separate company. There's a board of directors. There are stockholders, public or not, and shareholders. So a C corporation is a little bit different, but they're both on the 1120 form. Nonprofit organizations use a 990 form. They don't pay money to the IRS, but they do have to explain to the IRS how all of the incoming money is spent to make sure that you're spending it, wisely, and you're spending it by the law, and you remain as a nonprofit organization, basically. The due dates, and there's some changes from 2018 here. The due date's March 15. The due date is for S corporations, multi-member LLCs, and limited liability partnerships. That's all March 15. April 15 are individuals or sole proprietorships, single member LLCs, personal taxes, meaning if you work for someone else and you get a W-2 at the end or at the beginning of the next year, your due date is April 15. And the big change from 2018 is C corporations now are April 15. They used to be March 15, but in 2018, that's changed. Um, Last year, July 15 was the new April 15, and the extensions worked a little bit differently too. So you can forget about that. This year, all the dates are the same as they always are. It's March 15, April 15, May 15. So May 15 is for nonprofit organizations. And you have to file by those dates. Can you file before? Yes, you can. But most people who have businesses who owe money to the IRS wait, tell the accountant, well, file me on the last day or the second to last day, because that gives them more time to get the money together if you're not paying estimates. So these are the due dates. Now, aside from the due dates, we have estimate dates. And the IRS has a very strange idea of what quarters are. So the first quarter is January, February, and March. So 3 days after April 15, that is when you're supposed to pay your first quarter estimate. The estimates are usually based on the prior year's income or the prior year's net income, what you paid the prior year. But now with COVID in 2020, everyone was down. So when January, when April 18th comes this year, and you're paying your first quarter estimate for 2021, look at your 2019 numbers. That's what it should be based on. And you're probably, if you had a down year in 2020, you're probably going to have a better year this year. So you can get pretty close by looking at what you owed in income tax for your 2019 taxes. So the quarters are April 18, that covers January, February, and March. June 15th covers April and May. It's not really a quarter, it's 2 months, but this is the way the IRS thinks. And I have no idea why. Nobody can really explain that to me. I have a feeling it's because people start going on vacations on June 15, and they didn't want to make it July because people were going to be away on vacation for the summer, and they didn't want people to know that they have to pay estimates. That's the only reason that I can think of, but who knows? September 15 is June, July, and August, a regular 3-month quarter. And January 15th of the following year, meaning January 15th of 2021, was the fourth quarter. Now, think of it this way. First of all, the IRS, in their IRS bylines and in the law, we are all supposed to pay estimates. Some people don't, and some people wait until March 15 or April 15 to just pay everything that they owe, and they write a check, or it's done electronically, and they pay the IRS. Even if you do that, you could get a 1% interest and penalty for not paying estimates. Usually I don't see it happen. Sometimes I do see it happen, especially the IRS and the federal government are looking for ways of making more money for the federal government budget and paying back all these trillion-dollar loans that we're taking. So I would expect more letters to go out this year than in any other years if you don't pay estimates. You don't have to pay everything that you owe because you don't know what you're going to be owing March 15 or April 15. That's why they're called estimates. You want to pay as close, reasonably, as close to the amount that you think you're going to owe. You don't have to pay all 4 quarters. You can, if you owed in 2019, you owed $8,000, then you could pay $2,000 a quarter, and that would be 8,000. Or you can pay nothing on the first quarter. You can pay 3,000 on the second quarter. You can pay 1,000 on the third quarter, and you can pay as much as you can afford on the fourth quarter. So it doesn't have to be everything that you owe, but the more that you can pay in estimates, the better it is for your cash flow. And when the accountant or the tax preparer files your taxes, you're going to owe very little money, hopefully, if the estimates are anywhere near accurate. And the accountant can help you with that. I help my clients because I'm in their books every day. So I help my clients in terms of how much they should pay at each quarter. And I look at their bank account and we look at how much money they're expecting in and how much they owe in credit cards and all of that. But you can go up and down. It does not have to be the same amount every quarter. Think of it this way also. If you're working for someone else as a W-2 employee, then every week or every 2 weeks that you get your paycheck, taxes are deducted from your paycheck. So if you make $500 a week, you are taking home, $430 or $420 a week. So you're really paying estimates every week or every 2 weeks. So as a business owner, they do it. They don't do it every week or every 2 weeks. They do it every quarter. So you want to pay estimates to avoid the penalties and the interest letter that they will automatically send you. I believe, we all have to pay taxes. Nobody likes paying taxes, but we don't have to tip the IRS. We should just pay them, what we owe. And a penalty or an interest for not paying estimates is just kind of wasting money. So pay what you can. Now let's get into the actual deductions. If you have an office outside of your house, then everything that goes into that office is deductible. So the utilities for the office, the rent for the office, if you pay for a parking space in the building where the office is, anything like that, 100% tax deductible. But in home offices, things are a little bit different. In a home office, if you live in an apartment, let's just make it easy and say it's 1,000 square feet in that apartment. It used to be that the IRS said that you had to have a separate room dedicated to an office. But someone woke up one day and someone at the IRS said, in New York City, there's studio apartments. So how do you dedicate a room to an office? So the IRS several years ago changed this law, probably about 8 or 9 years ago, changed this law. So it's now based on square footage. So even if you have a studio apartment and you're using your kitchen counter and you're putting a computer there and you're putting a printer there and you're putting some files and file folders there, you can measure that kitchen counter and that's going to be your square footage. So if you have 1,000 square feet in your total apartment and you're using, let's just make it easy, you're using 200 square feet out of that 1,000, then 1/5 of your maintenance, if you have a co-op, 1/5 of your rent, 1/5 of your mortgage can be a tax deduction for the business. So there are real advantages of having a home office deduction. You get a deduction, but you can save money. You don't have to pay $1,000 or more rent in another in another out of the office, out of the home office. So it's now square feet. The other big one, which we'll talk about in a minute, are snacks or food, and that's one of my favorite. That's one of my favorite ones there. If you have now, they might change this for last year, but if you have an outside of the home office, and I have clients of mine who had a New York City office for the last 15 years since I became their bookkeeper. They gave it up in November of last year. They decided to have 5 or 6 people, full-time people, work out of their homes, and it's worked out really, really, really well. Better than they ever thought. They Zoom every day and they have conference calls, and it's great. And they realize, maybe they never really needed an office. That's a whole other story. But when they did have an office, the three partners of this entertainment company would call California for hours every night from their home because of the time change. They could not get a home office deduction because they already had an office outside. You can't double dip. Now, this came up yesterday in a big conversation with a client of mine, and I'm wondering if because of COVID and because of so many people moving back into their home office, even if they're still paying rent in their office, but didn't actually move out of their office, I'm wondering if the IRS is going to enable people to double dip, to pay office rent outside of the office, not being able to go there, and also a home office deduction. There's nothing in the tax law yet about it. They might change it. They might come up with it in the next couple of weeks. So, keep your eyes and ears open for that. I'm hoping that they will let people do that because I think it makes sense.
Question, Paul.
Yes.
There are 4 times to pay New York State IT-2105 estimated taxes. Do we have to pay each quarter equal amount?
No, that's what's so great about estimates. You can pay if your goal is to pay $8,000 before you file taxes on April 15 or March 15 of this year. The first quarter you can pay $100. The second quarter you can pay 4,000. You can skip the third quarter. The fourth quarter you can pay the rest of it. They don't care how you pay it or what you skip or what you don't. The idea of the estimates is that the government wants your money quicker than you paying it on March or April 15, so they can use it for other things and they can collect the interest and they can invest it. That really is what it's kind of about. So as long as you pay estimates by the fourth quarter, you will not get a penalty, but it can be any amount.
Thank you.
Okay, now let's talk about some other kind of industries. Licensed models can, in most cases, have manicures and pedicures tax deductible. They have to be licensed and a particular kind of license, I think. But I used to have a jewelry designer. She used to go to trade shows. She spent thousands and thousands of dollars on a table at a trade show. She used to go to, I think, Milwaukee, and she did one in LA, I think. Cost her $10,000 a table. And she was her own model. She would take very expensive jewelry and she would put it on her finger and she would show people her manicures and her pedicures. If she was wearing a pinky ring or something, they were not deductible. And every year that I had her as a client, she would yell and scream at the accountant and me saying, I want it to be deductible. And I said to her, well, call the White House, call the IRS, but we cannot make it deductible. You are not a licensed model. So that's something that they do look at. If you look at your tax return, each tax return has a classification of the kind of company you are. So by looking at that number, by feeding that number into the IRS computers, they're going to know if you're a bookkeeping company, if you're in the hospitality industry, if you're manufacturing, or if you're a model. And so you can't really play with that. That's something I'm very conservative about. Set designers, and I have a couple of set designers that I do bookkeeping for, and I tested this theory. I mean, this is the law at the IRS, but I tested this. I called one of my set designers and I asked her, did she see such and such a movie? And she said, oh yeah, I watch a lot of movies. I saw that one. And I said, I'm going to ask you something that is going to sound really funny. Tell me what it's about. And she said to me without any hesitation, I don't really remember what it was about. I watch it for sets. I watch it for the design. I watch it for the color. I watch it for the photography. So she really, she is the perfect case in this. If you're a set designer, Netflix, HBO, Amazon Prime, Hulu, they're all should be going under research. And that is a legal tax deduction. I can't do that. Even if I'm seeing a lot of, business movies and, there are several movies about bookkeepers and documentaries and stuff. There's a movie called The Accountant, but I cannot take that off as a business deduction. It's not research. It's my personal life. I watch a lot of movies. Any webinars, seminars, or conventions that you pay money for that is directly related to your business, they are 100% tax deductible. So if I'm a bookkeeper and I want to go to a webinar on how to become a massage therapist, then no, that I cannot take that out as a deduction. That's a personal expense. But if I go to a webinar about QuickBooks, or I go to a webinar about how to get a bookkeeping license or something, and I'm paying for that webinar, then that would be related to my business and that would be a tax deduction. My favorite tax deduction, my absolutely favorite one, is snacks and coffee are deductible as office supplies. I cannot tell you how many times I see Dunkin' Donuts or I see, Ann's Coffee Shop for $2 and $1.50 and $4, and it's put in as a business meal. Business meals in taxes are 50% deductible. So if the business meal is $100, you only get 50% of that. You get a $50 deduction. The tax software, you enter the $100 in a professional tax software. The second you hit that enter button, it becomes 50. It's programmed to do that. So a legal 100% legal deduction is to take off anything that's considered a snack. Now, sometimes it's a little bit difficult. If you go to a deli counter and you order a half a pound of salami, then no, I don't think that's a snack. But if you go to the other part of the store and you get a pre-packaged salami or slices of cheese or something like that that you can eat out of a bag, then I consider that a snack. And that is 100% deductible for either a home office or an outside of the home office. So my wife laughs. We go to Target about 3 times a year, and I go crazy buying snacks. Anything that I can think that is tax deductible for the business. I'm a little low on snacks today in my office, but I still have some left. I'm due to go to Target one of these days, and I can spend $200 on just snacks, and I lug it back to the office, and it is a real tax deduction. So that's one of my favorite ones, and also coffee. So if you go out and if you have a coffee maker in your office and you buy, $150 worth of pounds of coffee and sweet and low and sugar and creamer and all of that is 100% tax deductible as an office supply. If you go out and you buy a coffee maker for $25, then that would be a tax deduction as well. It ends up being an office supply. The same with Dunkin' Donuts. If you don't have a coffee maker, or you don't want to use your coffee maker in the office or in your home office, you can go to Dunkin' Donuts and bring it back to the office, and that becomes an office supply as well. So it could be thousands of dollars that you're saving in just, chips and bagels and coffee and sweet and low and cakes, all the Entenmann's cakes and the donuts and all of that stuff are all considered snacks. I keep a lot of cashews in this office, and those are all 100% deductible. So that's one of my favorite ones. An accountant told me that about a decade ago. Before that, well, probably about 12 or 13 years ago. Before that, I never used to put them in, but put them in. You'll be amazed at how much money you save. When you go food shopping, and what I do is I usually try to go food shopping with my wife, and she gets her own cart. I get my cart, and as she grabs stuff from the shelves and puts it in her cart, if it's tax deductible, I grab it from her cart when she's not looking, and I pay for it. It just makes it easier. If you put everything on one receipt, then you're going to have to keep the receipt and highlight uh, only the tax deductible items that you've purchased. This way, if you have a separate receipt, I keep the receipts from all the grocery stores that I pay for, so it's 100% tax deductible. Keep the receipt. I keep the credit card statement, and if it's ever questioned, I will be able to prove it. Computers, all computers for the office or the home office. When you buy a computer or anything that has a life expectancy of more than 1 year, the IRS would like you to book them as assets, as fixed assets. So even if you buy a $240 Chromebook, the life expectancy of that Chromebook is more than 1 year. So it should go into the bookkeeping system as a fixed asset. And the IRS now is saying, since 2018, you don't have to depreciate that asset over 3 to 5 years. You can depreciate it, meaning 100% of that amount of money that you paid for that computer could be depreciated in 1 year, the same year that you bought it. So they end up being deductible expenses in your books, but they should be entered into your books as assets. And I'm a real stickler for that. The IRS and the GAAP says in accounting that even if it's a $25 piece that has a life expectancy of more than 1 year, it should be booked in as an asset. That's what I do. So my books always show more assets than most other bookkeepers' books, and then I get pushback from some accountants who say, "What are you putting a $25 or a $40 piece in as an asset?" And they use the word minimus with me. What they say is it's too small to be an asset, and they make an entry putting it in as an office supply. And we get into some heated conversations about that. I'm kind of anal when it comes to this, which is actually a good thing if you're a bookkeeper. But I always put this stuff in as assets, and then we can either depreciate it over 1 year or over more than 1 year. Office supplies, printer ink, paper, tissues, cleaning supplies, anything like that are considered office supplies. And that's true also with a home office. So, except really, I mean, for home offices, really toilet paper is not included. But if you buy, a 3-pack of Bounty, then a portion of that you can take as a tax deduction for the office. Or actually, you can probably take all of it, and you can say you're using all 3 rolls for the office. Transportation getting to and from client meetings. Now, technically, if I take an Uber or a Lyft from where I live to where my office is, which is about a 15-minute walk, the Uber or the Lyft that I take to get to the office from home is not deductible. They do not allow you to deduct the transportation to and from work, just like a W-2 employee working for someone else. Same if you're self-employed. But if you're using a personal car for business, or you're taking an Uber or a Lyft or a taxi from your office to a client, then that is tax deductible. So 100% tax deductible for Ubers and Lyfts and taxis. If you're using your personal car for company business, then what you're supposed to be doing is keeping a log of where you're going, what client you're seeing and why, and you're supposed to keep a log of your mileage. So I actually have a client who delivers. Last year, she delivered for several different companies, and she used her own personal car. She had 7,000 miles at 59 cents, 59.5 cents a mile, um, being reimbursed to her, and that would be a deduction from the business. So 7,000 times 59 or 60 cents, it's a lot of money. So she got a really nice deduction, and that deduction for the business is not taxable for her as a personal person, and that money is supposed to pay repair and maintenance for the car. So it really, for her, it really, really works out. But you have to keep some kind of a log of mileage. You can do it on Excel, and there are a lot of apps out there that will either interface with QuickBooks or not. But there are a lot of apps to keep logs of where you're going and mileage.
Question.
Rental car, yes. Question?
Wouldn't depreciating over 1 year be the same as putting it as an expense?
Well, that's a good question. Not really. In terms of the profit and loss, yes. But if you have a $250 computer and it's in there as a fixed asset, and the accountant says, no, I just move it to office supplies, it's going to show as office supplies. If you depreciate it over 1 year, it actually shows as a depreciation expense of that asset. And that's a different account. So there is a difference in what it looks like and how the IRS will look at it. But you're right. There's no difference in terms of the net profit. That stays the same.
Thank you.
Any other questions before I continue?
Not at the moment.
Okay. Um, let's see. Rental cars. Any kind of rental car, and I do rent cars from time to time, and I drive myself out to Long Island. I have a couple of clients out there. I have a client out in Westchester. I didn't do that last year because of COVID, but this year I will probably in May and June and July start doing that again, just to be with them face to face and go over their books. I like that personal touch. So that would be 100% tax deduction. If I'm renting a car to go to Jones Beach, then no, that's not business. That's a personal expense. Meals that are with clients. Now, this is an interesting one. I have a client who is in the sports business, and I'm not going to mention any names or any of his clients because they're famous people, but when he goes out with a client, he can spend $800 on dinner with him and his wife and the client and the client's wife. It could be $1,000 for dinner. Those are tax deductible at 50%. And he does a lot of those during COVID and not during COVID. He does a lot of those. He also goes to the same restaurant with only his wife, and it's a $700 dinner because they're big drinkers. I don't have any way of really separating that as a bookkeeper. I don't know which meals are business and which meals aren't. So I have to kind of take his word on it, or I make decisions as a bookkeeper, or I talk to the accountant and the accountant makes decisions. What's a reasonable amount of money based on the income and based on the profit? What's a reasonable amount of money to put in a meal category? So that's a tricky one. And for some businesses, my meals are so low that it's audit proof. No one's going to audit me under meals because I don't eat very much when I'm in the office. Most of what I do is I eat my snacks here. I don't sit down and really have a meal. I have breakfast and I have dinner. So breakfast and dinner are not deductible. But meals with clients, just understand that they are 50% deductible. The IRS says that the deduction is for your client. You and your food are at a restaurant is not a deduction because you have to eat anyway. So, use that for what it's worth. But this is a big category that I look at. If someone makes $100,000 of revenue for the year and ends up having a $10,000 profit, I I would expect, and the IRS would expect, to have a higher profit than 10,000. So I might actually say go through the meal category and take some of the meals out so the profit goes up. Especially if I know that a particular client is these are not all business meals. He's padding the business meals, or he's taking out his wife and family for a meal. And I'm pretty good about that. I know where someone would take a client as opposed to where someone would take their family. So we can kind of determine that and make some executive um, decisions to try to keep people out of audits. That's kind of
Question.
fun.
Are meals deducted at 100% for 2021?
No, they are deductible at 50%. Except now the only exception is, and this is something that the IRS hasn't really dealt with yet, so we don't really know how they're going to deal with it in an audit. But in New York, March 15, March 16, and all of April and all of May, there was a shutdown. Most people were not working in offices, they were in their homes. But many people were still making phone calls, many people were still Zooming, many people were still making money and running the business from their home. Therefore, there is a category under meals um, called working meals. And working meals, if I get something delivered to this office, especially during tax season, and I happen to have lunch because I'm getting tired because I put in 12-hour days all the time, I will take a bite of my lunch, and then I'll go right back to doing accounting and bookkeeping. And then I'll take another bite and I'll go right back to accounting and bookkeeping. That is called a working meal, and that is 100% deductible. Any other meal, if I order a meal here and I stop working for 15 minutes to eat, then that is 50% deductible. So, we all play with that a little bit, but I wouldn't abuse that because if you put too much in working meals, it's a little flag and you could be audited for something else and then they'll find that. So I would be pretty conservative. But yeah, that's the only way that you can get 100%, or if you have employees. So if you are still going into an office and you have employees and you decide as a business owner to pay for lunch for all of the employees, then that would be 100% deductible because you're paying people to stay at their desks and work. And that's why you're paying for lunch. So there are some exceptions to that 50% rule.
Thank you, Paul.
Any other questions?
Not at the moment.
Okay. Um, Also, computer software that's really probably went up last year because everyone was using Zoom. So if you have the paid edition of Zoom, that is tax deductible. If you're using Adobe or you're using, any online computer software, or if you go out and buy the desktop version of QuickBooks, all of that, cloud-based or not, is 100% deductible. So if a computer is deductible, everything that goes into the computer or coming out of the computer is deductible as well. I put this slide in here just because the PPP changed so much, and nobody knew at the beginning how the IRS was going to deal with the deduction. So before we get to this slide, let me explain to you how the PPP originally worked. The PPP, the Payroll Protection Plan, was supposed to go to small businesses and large businesses to cover payroll for 2.5 months. And they had a very complicated equation and figuring out how much you're eligible for and what the payroll was in the first 2 months of 2020 before COVID hit. And nobody really knew, but the law was that you would eventually be given an opportunity to get this loan forgiven. So when you first got the loan, if you got, let's say you got $80,000, then that was an unforgiven loan. So at that point, technically, you owed that money as a long-term loan. When it was forgiven, and the original forgiveness was supposed to be done by December 31st, 2020. So if it was forgiven in that same year, then the loan liability would go away and everything is back to zero. And it's free money. But if that $80,000 was spent on payroll, the payroll, the 80,000 could not be a tax deduction on your books. So you have money coming in, money that's forgiven, and we would make the appropriate entries. But the money that you spent, the 80,000 that came in and you spent it on payroll, is not a payroll expense. It goes against the loan, almost like payments against the loan, which would have been forgiven. Now they've changed it. They've changed this whole thing after many, many months and probably 150 changes. They are now saying that, I mean, first the IRS said, no way are they going to allow what we call a double dip, which is getting free money, getting that money forgiven, and also using it as a deduction against your expenses and your net profit. Congress overrode what the IRS said. So I'm sure there are people at the IRS who are not happy. So Congress said, yes, you can. Because of COVID, it really hit hard. Not only can you get the SBA loan forgiven, you can also use that money that you paid payroll with as a payroll deduction. And I have clients doing that. So you can take an $80,000 profit, and then if you apply the PPP after it's forgiven, or actually, yeah, after it is forgiven, you can use it for the payroll cost. So you can actually double dip on it, which is really, really, really good. So there's a lot of people who did get the PPP loan forgiven in 2020 who will probably show a negative profit because you can apply the PPP loan to payroll and rent and whatever else that you paid. So the whole PPP, it's changed so much. But the good news is that once it is forgiven, you are able not only not to have to pay it back, but you are also able to deduct it. And I think what's going to happen is even before it's forgiven, if you have the loan forgiven in 2021, they might let you take it as a deduction in 2020. But if not, it'll be 2021. I don't know if that's really decided yet. It probably will be awfully soon because people are starting to file their income tax. So this slide I just wanted to put in here as a kind of an extra thing because a lot of people are concerned about what they're doing with the PPP. 1099 subcontractors. This is another conversation I have every day of my life, probably including Sundays as well. even in July and August. I mean, this is a big, big, big conversation that people have. First of all, independent contractors. These are 1099 independent contractors. They are individuals, meaning sole proprietorships, or LLCs, LLPs, any kind of business that's not a corporation. If they are providing a service to you and you are paying them not with a credit card, but you're paying them with Zelle, Venmo, cash, check, uh, bill pay, any other way that you can pay them. So you don't have to worry about if it's a product, if it's something that you're buying that, an inventory product or a product that you're buying. This is really for services. So if they are individual sole proprietorships and you pay them using Zelle, or you pay them using cash, or you pay them using a check, if you pay them $600 or more per year, then you have to provide a 1099. By this year, it was February 1st, 2021, because January 31st fell on a Sunday, but usually it's January 31st. In the IRS law, the IRS can, and they never have, because they know it would just be a nightmare, but they can, if they really want you to get it. They can say to you, get a 1099 for even products that you're buying from non-corporations. Nobody ever does that. It would be an absolute nightmare. Do it for your services. Okay. Every January, when I'm putting together the 1099s, and I've been hounding my clients all year to get names and addresses and tax ID numbers or social security numbers, I have 8 or 10 1099 and 1099 information that's incomplete because I don't have the W-9 form. So the IRS says, nobody does it, but I'm telling you guys out there, do this before you pay someone for any service. Get a W-9 form filled in and give it to your bookkeeper, or if you are your own bookkeeper, enter it into QuickBooks so that when January comes and you want to get all the 1099s together, you will not be missing any information. I always think I'm going to have a heart attack and I'm going to die in this office with my head on my computer on a W-9 form in January because it's so stressful. I have 120 something companies that I have to do the 1099s for, and I'm always missing information. It's horrible. So be a good business owner and get W-9s before you pay anyone. Make me happy, and make your bookkeeper happy. 1099 contractors are companies or individuals who you are paying not on payroll. So if you're paying someone with taxes taken out of their paycheck, then they are not going to get a 1099. They'll get a W-2 form. But a 1099 is you hire a person to perform some kind of service or labor, and you're paying them $275 or $300 or $500 or $1,000 or $30, whatever it is, but no taxes are taken out. That's when you need a W-9 and a 1099 form if it's $600 or more. The exception to that rule is if you are paying someone with a credit card. Credit card companies will 1099 through their company, through their bank. So you don't have to worry about paying your accountant with a credit card and also sending your accountant a 1099, because the credit card company will do that only if it's outside of a credit card. The other exception to the rule is if you pay a lawyer $3 for the year, you have to 1099 the lawyer by January 31st. That's the only exception. Everyone else is 600 or more. Lawyers are, if it's $1, you have to 1099 a lawyer. it used to be up to this year, it used to be a 1099 miscellaneous, MISC. Now there's a new one starting January 1st of 2021. Subcontractors get a 1099 NEC, and the 1099 miscellaneous goes to your landlord if they're, or anyone who you pay rent to, if they are a sole proprietorship or an LLC and you're paying it out of the business account. So two different sets of 1099s. That made me crazy this year because you have to run two different reports and you have to e-file it separately. So 120 companies times two, I did at least 240 reports in 31 days in January, but I lived through it. Anyway, this is a real important thing about taxes, because if you get caught, if you have a deduction in your books for a subcontractor and you get caught not sending a 1099 out to this subcontractor, I think it went up to $150 or $175 penalty for not sending it out. So you have your choice. You either take the chance and not send it out if you don't have the information and you can't send it out, or you take the business deduction and in your books you make it a personal you make it a personal expense, so the business doesn't get a deduction. If the business if the business doesn't get a deduction from that, then you don't have to send out a 1099, but you're going to lose that deduction. So depending on how much it is, you should do one of those things. But every year there are clients of mine who just cannot get a W-9. The people are, no longer, their email changed, their phone number changed, maybe they're not in business anymore, and we can't send 1099s. And in that case, we just take that chance that we won't get fined. And usually you don't. But this year, the IRS is going to be looking for stuff like this because they need more money, and the government needs more money. So they're looking for more ways to fine you and to penalize you for things. They are due again on February 1st of this year. Usually it's January 31st, and everything that I just said is really in this slide. The big exception are credit cards. Now, I ran into a situation, by the way, with QuickBooks Online, if anyone uses QBO, where the first payment was made of $200 to a lawyer with a check from this company. All the other payments, and it was like $30,000, all the other payments were made with credit cards. So the credit card company is going to send a 1099. The IRS says because the total is more than 600, or for a lawyer, it doesn't really matter. For a lawyer, it's any amount. QuickBooks Online did not allow me to create a 1099 for $200. So I had to go into my e-filing system that doesn't connect with QuickBooks Online, and I had to do it manually. I had to type out a 1099 form for that particular lawyer for $200. So that's, there's always exception to these weird rules. Okay. The other thing is about subcontractors. Doesn't really have to do with taxes, but think of subcontractors as independent contractors. So if you hire a subcontractor and you're giving them rules, this is when I want you here, this is how I want it done, this is when you take lunch, then they are really part-time employees. They are not they're not independent contractors. So be very, very careful. If the state comes in and they do an audit and they start questioning people who are subcontractors, I've had a couple of companies audited for that purpose, and the New York State agent asked them for me to produce a website, business cards, and my original business certificate from 1995 that I had to find. And luckily, I knew where it was. And they wanted to see it to make sure that I was truly an independent contractor. They wanted to know how many other clients I had. If they were my only client, then the New York State would probably insist that I would be a part-time or a full-time employee. But I had at that point I had 80 or 90 clients, and so I passed that test. So be very careful with the 1099s. Really, really important. Um, okay. The other thing I just want to talk about is a lot of people say, well, can I file my taxes for free? Do you really have to go to an accountant for this? And my answer is really kind of yes and no. Yes, there are ways of filing taxes for free, not business taxes, but personal taxes. This is called the 1040 EZ form, and H&R Block and Liberty and a lot of the places, TurboTax, you can do this online, and you're going to use standard deductions. So sometimes, depending on the amount of money that you're making, either as a single person or married or head of household, the standard deductions are $12,200 for a single person. So if you're making 15,000 a year, then and you deduct 12,200 without doing all the work, without going to an accountant and everything else, then it might be worthwhile for you to use the 1040 EZ. But for business, any business, even if you're a small business, you're going to have more deductions than a single person working for someone else could possibly have. So it wouldn't be a good thing to use a 1040 EZ, even if you're a single member LLC or a sole proprietorship. So I would do the full taxes, do the Schedule C, and go to an accountant. Um, so I mean, I really, really would not recommend this. The other thing about this is nothing is really free. If you go to TurboTax and you do your easy, your 1040 easy form for free, then you're putting in your social security number, you're putting in your name and your address and your email, and you're putting in your birth date and whatever else that they want. And you don't know what they're doing with that information. So does it cost you any money? No, but it might cost you other things. It might cost you a lot of security in information that you don't want out there. So I don't like, free for me. I mean, I used to be a real pain when we went to the movie theater, and they always used to ask you before COVID, do you want our free card? You get rewards and you get free popcorn. And I used to look at the people and say, it's not free. You're going to have my firstborn if I give you all this information. And they would give me a crazy look, and I never got a card from a movie theater, because I don't look at that as free. That's why they reward you, because they now have all this information about you. So I don't like that. In taxes, you should really pay a good accountant or a good tax preparer who will keep your information private.
We do have a hand up from Stacy Jensen. So I'm going to ask you to unmute and state your question. Stacy?
Hi, can you hear me?
Yep, we can.
Hi. So unfortunately, my business didn't make money last year, and it's my first year in business, largely due to COVID. And so I had some unemployment, and then the rest of it was all my personal savings. Would you recommend still hiring someone to do my taxes for the deductions that I'm going to take, or can I do that on my own?
I would probably hire, or at least, it doesn't have to be a CPA, or, we'll talk about that in a minute, but it doesn't have to be a top accountant. But first of all, when you got unemployment, did you take taxes or let them take taxes out before you got your unemployment check?
I did for most of the year. I did their standard, I think 10%. And then I
Okay.
think towards the end of the year, I needed the money, so I changed the percentage, and I didn't take for a couple months. I didn't have anything taken out.
Okay, so right there, then you should really see an accountant because you may owe not enough taxes were taken out, so you're going to owe something to the government. So
Okay.
whenever you owe, I would say don't do it yourself. Don't use a software, because it's going to be too complicated, especially with COVID.
Okay. Okay. Thank you.
But we'll talk about that. You're not going to have to spend thousands of dollars for a tax return.
Okay. Thanks.
Okay. Yeah, that's one of the things that came up last year with a lot of my clients who were on unemployment. We were looking at which way are they going to get more money, unemployment or PPP, and we decided that in most cases it's a better deal getting unemployment. But we also made sure that all of my clients who are on unemployment got the most amount of taxes taken out of that unemployment check, so they're not going to get hurt later. And a lot of my clients did, most of my clients did that. And so they should break even. They shouldn't owe on that when they filed income tax. So let's talk about that a little bit. There are different, what I call brands of tax preparers. One brand is called an EA. An EA, an enrolled agent, is an IRS. They are enrolled with the IRS after they take an IRS approved course. And anyone can take this course. H&R Block gives them. They give them online now, I think. A lot of the national or regional tax prepare places uh, give this course. And I never actually took it because I just don't have the time. But around here, it's every Saturday and it's like 8 hours. And I just don't have the time because I work most Saturdays, even if it's outside of tax season. So I never really did it. But I also don't want to be an accountant and I don't want to file income taxes. I'm really a bookkeeper. But anyone can take this course and they cover all 50 states, IRS laws, and the state laws, and all the forms. So it's a very intense course, from what I understand. And once you pass that course, two things can happen. Number one, the place where you took the course, if it's H&R Block or Liberty or one of the other ones, if you did very well in the course, they could offer you a part-time job. So you can go right into it, working at a good place, getting paid to put together tax returns for people. That's one thing. And the other thing that you can do is become an EA, an enrolled agent that the IRS will approve. The only stipulation to that is you cannot be behind in your own personal taxes. You have to be completely up to date for the IRS to give you that EA status. And being an EA, every tax return that you sign off on, the IRS has a file on you. So if you're ever audited, and if any of your clients are audited and they come through it well, then you get a good, you get a star, you get a good mark next to your name. And there are EAs who I deal with. They've been EAs for 20 or 25, 30 years, and they have a wonderful record with the IRS. So if any one of their clients get audited, they really get treated very well because the IRS knows that as an EA, they do really clean, accurate, good tax returns. So being an EA, is not anything less than being an accountant or being a CPA. So I know some EAs that are absolutely brilliant. One of my favorite ones, Larry, he's out in Long Island. He is a walking encyclopedia. He is as passionate about taxes and accounting as I am about teaching and as I am about bookkeeping. He absolutely loves what he does. He's done it for 42 years, I think. And that's all he's ever done. He works 7 days a week. He never takes a vacation since I've known him. And he is not an accountant. He is an EA. He knows more than many people who have more higher credentials than he has. So, and because he's an EA, he usually charges less. He can do a tax return for much less money. And sometimes he charges what a CPA would charge because he's so good. But a lot of EAs, they have the knowledge. You can save money going to an EA rather than an accounting firm or a CPA, a certified public accountant. So the bottom of the line is an EA, but it doesn't mean that they're bottom of the line. They are very good, smart, dedicated people. Some, many of them. The next one up is called an accountant. An accountant has more schooling. They do have a business degree. They do have to take, in most states, they have to take, in New York, and New York is one of the stricter states, they have to take professional credits. They have to go to webinars and seminars and IRS approved things so that they have to get their credentials and keep their credentials up every year. An EA has much less to keep up. They still have to go to some webinars and seminars, but not nearly as many credits are needed. A certified public accountant is the high on the totem pole. And every time I work with a certified public accountant or a CPA firm, they will ask me at the end of the year for every credit card account, every bank account, every loan account, the last reconciliation that I did. And I have to go into QuickBooks and export it as a PDF file and send that to them separately. They are, because they are at the top of that totem pole, they are very careful on what they sign off on. So they ask me for a lot more than accountants or EAs ask me for, generally. But they also charge a lot more money. So I have a small client of mine who had a CPA, very, very small corporation, making a couple bucks profit, but not all that much. And the CPA was charging them $2,300 a year for an S corporation tax return. The EA that she's now seeing, one of the people who I work with, are charging her 800. So, and the quality is exactly the same. She does not have a very complicated tax return. So take a look. You can do a search for EAs. You can do a search for accountants. You can do a search for a CPA. The other thing about CPAs, or not just CPAs, but any kind of a tax preparer, is think of, when you're looking for a tax preparer, put yourself in the mindset that, God forbid, if you need surgery and it's not an emergency, but you need surgery down the line, what are you going to do? Are you just going to, go to the internet and just pick a surgeon out of an internet website? Or are you going to go to particular surgeons and have a conversation with them and see where they graduated from, and see how many other people they've done surgery on who have the same problem that you have? And when I needed surgery many, many, many years, like 30 years ago, my mother actually asked the guy, where did you graduate in your class? What number were you? And he said, number 2. And that was good enough for her and me. And he was great. He was a wonderful surgeon and everything is fine. But you really have to look at tax preparers or accountants as if you need surgery, because they're doing surgery on your finances, which is almost as important as surgery on your body. So I would be very careful, sit down, even if it's over Zoom, ask questions of the tax preparer. If your due date is March 15, ask the tax preparer, are you going to guarantee that if I get you everything you need by January 18th, are you going to not put me on extension? If you don't want to be on extension, some people don't care. But if you don't want to be on extension, make sure, let them commit that if they have everything from you that they need, then they're going to commit to doing your tax return before March 15th. or before April 15 or whenever it's due. Um, talk to them about how they work. Talk to them about, do they check the books, or whatever you give them or whatever your bookkeeper gives them, do they just go with that unless there are any glaring errors and really glaring mistakes? Most of the accountants who I work with, I know they look at my work. And I don't look at that as something bad at all. They catch me on little things that, or they have questions things that they don't understand. I know they're looking at my work, and anything that they find that has to do with taxes that they want to adjust in the books, then they will go into the books and adjust it. The better ones, actually, they don't go into the books. They will call me and say, can I log into your books with you? Can I log into your computer? And I want you to do the entries, and I'll tell you what to do, because accountants and tax preparers are not supposed to ethically go into your books. So I try to keep that separate. So when I'm working with an accountant or a tax preparer, tell me what I need to do. I'll do it, because I'm the bookkeeper. I don't like it when a CPA said, oh, just send me the books, I'll take care of it. They're really not supposed to. If you don't mind that, great. But these are questions that you should be asking your accountant about how they work. Do they really go through your books and really change things? How often do they go to seminars and webinars? What kind of other clients do they have? If you're in manufacturing, how many other manufacturing clients do they do taxes for? How many other set designers? How many other service companies, as opposed to product companies? How many food companies? How many restaurants do they do accounting for? There are accountants who specialize. I mean, there's an accountant who I work with, and I think 80% of his clients are golf professionals. So he really knows that business. So if you're a golf professional, he's the guy to go to, because he knows all the tricks that I don't know for for golf pros. So sit down with an accountant, or I guess now over Zoom, and ask all the questions you would of someone who you would be hiring as an employee representing your company. So there's an EA, there's an accountant, and there's a CPA, a certified public accountant. These are just a couple of websites that I found: thumbtack.com, naea.org. One of the places you might be able to find an enrolled agent. But you can Google, you can, the other way of finding a really good accountant or a good tax preparer is ask an owner of a company who you do business with. That's a great way. And all you have to do is, hey, Harry, do you like your accountant? Oh, yeah, he's great. I've been with him 25 years. He's great. He saves me money. Well, then he's good. And you might want to get a referral. So networking is a great way to find an accountant. I wouldn't just go cold turkey unless you really don't have any networking, and then you can start calling accountants and having these kinds of conversations. Every time I take on a new client, I have a conversation with the client. I am in a very good position. I don't have to say yes to everyone. I want to make sure that personality wise, we have a match. If I say to a client, well, I want to make sure your books are really as audit proof as possible. I've had clients or prospective clients come to me and say, well, what is that going to cost me? And my response is, well, that's the wrong question. If you have to ask me that, then I don't think we have a match here. And then they get all defensive, and they say, well, just tell me what your rates are. And I give them my rate, and they say, oh, I thought it was going to cost a lot more for the service that you're providing. And then they end up becoming a really good client. And most of my clients I've had for more than a decade, because from the day that I meet them, I build a relationship. I have more secrets about my clients than I care to. But if I can't find them, if they're not in the office, I can go through the books. I know where they buy gifts. I know where they vacation. I know where they bought their car from. I know the restaurants that they frequent. I can find them if I really need to. So building that relationship with an accountant is really the same way. It's not just someone who you should see once a year at tax filing time. It should be someone who you can feel free to pick up the phone and call with a question. I usually have people call me because of my knowledge in not just bookkeeping, but in taxes. So my clients call me first. If I don't know the answer, then they call the accountant. So we're a team. Bookkeepers, accountants, and clients are really a team. And I always I want the books to be as 100% perfect as humanly possible. So if they ever do get audited, I'm going to sleep like a baby the night before the audit because I know that they're not going to find anything. And that's a team. That's a good team. And that's what everyone needs. So finding an accountant if you can ask other people if they're happy with their accountant, if they are, then that's someone, that you might want to talk to. The big 2018 tax changes, meals and entertainment used to be the big category that not only business meals, but if you go to a baseball game or you take a client to a Broadway show, eventually this year or next year, that'll happen again. The tickets used to be tax deductible, no longer. Entertainment is no longer tax deductible. Even if you're in the sports business and you have to purchase a ticket to take a client out, the ticket is not deductible, but the $35 hot dog when you get inside is as a business meal. So what I'm doing is meals and entertainment. I'm deactivating that account after December 31st, 2017. And January 1st of 2018, I'm creating a new expense account called Business Meals. And it's only going to be meals at restaurants. A lot of the other meals might be office supplies, might be working meals, other things that you can do. Even if you are a professional golfer, country club memberships are not deductible. But once you get in, the food and everything else is. All what is called pass-through entities, sole proprietorships, is part of your 1040 April 15 taxes. Single member LLCs is part of your 1040. Multi-member LLCs is not part of your 1040, but it is considered a pass-through entities. LLPs and S corporations. Basically, every kind of business except a C corporation is called a pass-through entities unless you're an individual working for someone else. You're not a business. They have a new, starting in 2018, if you have $100,000 net profit in your books at the end of the year, your taxable income is reduced by 20%. So 100,000 minus 20% is 80%. Now, there's no way of putting that in your books, and you don't have to, but when the tax software that accountants and tax preparers use, that 100,000 goes in automatically. When they enter that 100,000, it gets entered as 80,000, because that's the way that program that's the way that software program is designed. So 20% off. So don't be disappointed that entertainment is not a deduction anymore. They're giving you free 20% deduction at the end of the year. The other big thing about 2018 moving forward is that the net profit of S corporations or multi-member LLCs that flow through to a K1 form used to be between 30 and 35% personally taxed. Now it's down to 21%. So if you have an S corporation, Because of this law, you might actually be paying less taxes in many cases than if you had a single member LLC. But it obviously depends on the numbers. But it's much 15%, at least 15% less than it used to be in terms of the K-1 personal income tax with the IRS. So that 2018 law really changed, and it changed the tax code, and it saved a lot of people money. The other big ones is corporations. S corporations and C corporations can give any amount of money to any charity as tax deductions. Individuals, there is a threshold. So if you give $300 a year and that's your only donation as an individual or a single member LLC, that is not deductible. You have to hit, and I always forget what it is. I think it's a couple of $1,000s or 2,500, something like that. But if it's less than a particular amount, none of your donations are tax deductible as an individual. But if you own an S corporation, yes, everything is tax deductible. If you used to pay pre-2018 25% rate on your personal income tax, it probably went down to 23 or 24. It may go up again because of COVID and all of this. We'll see what happens. But as of now, for 2020, it's probably going to be 1 or 2% less than it was for the same amount of money in 2017. There are also additional tax deductions because of COVID that you don't have to put into your books, but it's in the tax preparer's software. That's another reason why you can't do it yourself, because there are COVID extra deductions because of COVID and unemployment and things like that. Also depends on what industry that you're in. Restaurants and hospitality get some extra tax deductions. And individuals, this one is pretty important as well. New York City and New York State property taxes, it's a total of $10,000. If you're $9,000 of property taxes in New York City and $4,000 for the state, you're going to lose a tax deduction of $4,000, because the amount that you can, the top amount that you can declare in state taxes is $10,000. And New York and California are the two big ones that are really hit by that, because the taxes are higher than other states. All of this might change now that we have a new administration and a new Congress and a new Senate. So we'll see. Stay tuned for 2021. And that is, what time is it? We are, look at that, we're right about perfect. We just have a little bit of time, and I can open this up for questions. And I'm glad we have about 15, 20 minutes.
Yes, so if you have any questions, you are able to send them to the Q&A function or the chat box. And I will give people here the ability to talk. So let's see.
Yeah, I don't see the chat box.
No.
So I will rely on you.
Okay. Damaris, are you there?
Yeah.
Okay, great. So doesn't look like we have any questions.
Really, I thought we would have some questions, but I tried to be pretty precise.
All right.
Also, Gabriela had mentioned if there's any Spanish speaking participants on the call, you feel free to ask your question in Spanish. I'm going to say that in Spanish now. Si hay participante en la llamada que prefieren hablar español, puede preguntar en español y yo le traduzco a Paul. Gracias.
I hope this was some help to people, because a lot of people just don't know about all these little tax rules.
Okay, so we do have one question. Since my
Okay.
business will take a loss, I didn't report quarterly estimates. Is this a problem?
No, not a problem at all. If you know that you're going to file a loss, and there really are not going to be any significant taxes to pay, other than maybe Social Security and a couple of other minor things. No, you don't have to pay estimates if you're really not going to owe any money. So that's perfectly fine. I
Okay,
mean, it's not fine. It's bad that happened because of COVID, but it's fine for taxes.
thank you. All right, so it doesn't, oh, here we go. Great information here. Can you talk about 1099 subcontractors again?
In what way? Because I could talk about that for hours and hours.
Leandra, I'm gonna ask you to unmute.
Hi, hi. Thank you so much for this great information. It's so helpful. It makes a lot of things clearer to me.
Great.
I'm an S corp. You spoke about 1099 subcontractors as opposed to regular 1099s. You gave the distinction, and I was taking notes furiously on the 1099 regular, that the subcontractor thing went over my head. So just what you discussed in the slides would be great.
Sure. Okay. So 1099s and subcontractors, they're really the same thing. So the basic rule, and you can Google this. The IRS has about 25 different, a list of 25 or 30 different specific things that you have to make sure of before you know that someone is a legal 1099 or a subcontractor. Uh, and some of these things are, as someone who hires a 1099 for a service, you are not allowed to tell them, this is when I want you here, and I'm going to supply the tools, and I'm going to tell you how I want it to be done, and and this is how I want it to be done. You are not allowed to do that. Hence the word independent contractors. So that's the main thing that the labor commissions of the states are looking for. So, and I'll tell you, I can tell you countless, I mean, horrible, countless stories about people who were being paid as a subcontractor, meaning no taxes taken out of their checks. They were working 30 hours a week for 2 or 3 years, and they got into an argument, or they got into a problem with the owner or his boss, and he got fired or he quit, whatever, and they went to the unemployment office, and it opened up a whole can of worms, because you can't get unemployment. I mean, COVID was different, but in a non-COVID year, you can't get unemployment benefits if you're a subcontractor, because a subcontractor, you are a business. You're either a sole proprietorship, or you're an LLC, but you're some kind of business. You really are not an individual. So you're treated as a business. Businesses can't get unemployment, only individuals can. So that opened up a whole can of worms. And the Labor Commission found out that this guy was getting paid as an independent contractor when he should have been a full-time employee. And this particular company, this is before I took over the bookkeeping. Um, this particular company got fined. They had to pay about $150,000 in payroll taxes, and they got interest, and they got penalized for that. So you really have to be careful with subcontractors. When you think subcontractors, think of a plumber. That's probably the best example that I can give you. You are not going to ever call a plumber and say to a plumber, this is when I want you here. I will supply all the tools. I'm going to tell you when you can take breaks, and I'm going to tell you how I want this fixed, what materials to use. You, who does that with a plumber? You call a plumber, the plumber says, I'll get there when I can. I will bring my own tools. Don't worry about it. I will fix it in the way that I'm going to fix it. Take it or leave it, basically. Uh, think of that example when you think if someone is a subcontractor or should that person be a part-time or a full-time employee. A lot of people pay people as a subcontractor because it's cheaper. There's no payroll taxes, but it ends up biting them years later because something could happen. An independent, someone who you're paying as an independent contractor goes and tries to collect unemployment, and then that's going to be a big problem. So, there's a lot of other things, but I mentioned the most important. No, they're not allowed to be on a schedule. They're not allowed to be controlled by you as a boss. You have to hire, you're hiring a company to perform a service and you're letting them do it independently. And if you don't like how they do business or you don't like how they fix something or how they provide the service, you don't have to use them again. You don't have to fire them and give them 30 days notice and all of that. You can just pay them and say goodbye. I'll never see you again. Have a good life. You can't do that with an employee. So the rules are very, very, very different, but think of it as having control. If you have control of what someone does and how someone does it, then they should be an employee. If you don't have that control and they're independent, then they are a 1099 subcontractor. And then you need a W-9, not a W-2.
So I have a more specific, in light of that,
Okay.
specific here. Okay. I am an educator and I get the, okay, so there's an agency that I work for and they are paying me a 1090 on a 1099 basis. Now, I get the contract through them from the DOE, but it's through them. They own the contract.
That doesn't really matter because they're hiring you.
Okay, fine. So
You're not part of the contract. It's their contract and they're fulfilling their contract by hiring you. So your
I hear that.
relationship is with them, not with the DOB.
Okay, further question to this is they are requiring me to do certain reporting.
Okay. Yeah, I've gotten into this conversation with one of the schools that I for years that I've done in-person classes. And basically, yes, I have paperwork that I have to do there. I have to take attendance and I have to do paperwork in a particular way for the state, but that's not their rules. That's the state rules. If the school gave me a QuickBooks book and said to me, take an 8-hour class and I want you to teach chapter 1 and then chapter 3 and then go to chapter 2 and spend a certain amount of time on chapter 6, then I would be an employee. I would be a part-time employee. And when I first started with them about 12 or 13 years ago, I don't want to ever be an employee again.
No.
Ever. So I sat them down and I said, look, I've been teaching for a long time. Let me do my thing. I really want to be an independent contractor and I want to be a legal independent contractor. I don't want you to get in trouble. Let me teach a class for you. Let me just ad lib. Let me just do my own thing. And if you really don't like it and you really want me to teach it the way you want me to teach it, then let's sit down and talk and maybe I'll be a part-time employee for you. And after that first class, they looked at me and smiled and said, you're an independent contractor.
Okay, so did you have to give them lesson plans?
Nope. I have taught for so many years that these are like 1-day classes. These are like 10 to 5 or 9 to 5 classes on QuickBooks or accounting. And I don't even prepare anymore. I mean, I just ad lib for the whole day because I've done it for so long. I mean, I think about it and I kind of prepare in my head, but it's the same information. I just, whatever comes out of my mouth, I don't even know anymore. when I teach. I'm just in kind of like a nice autopilot. And so no, I don't do lesson plans. I don't even like the idea of handouts, because if people are taking their own notes with all the reading that I've done in educating people, if you're taking your own notes, it's going to sink in your brain better than a handout that I give to you.
That's a
So I
teacher.
don't even use handout. I'm very, very independent when I teach.
Okay, so if they're requiring lesson plans, what does that veer into the, okay, am I now becoming an employee status?
Well, if they're lesson plans, are they lesson plans that you can come up with and do they have to approve? Or do they
That
just
sort of
say
thing.
lesson plan and then you can do whatever you want?
Uh, I come up with, but they have to, they approve it.
Okay, then that tells me that you're probably like on the borderline, but that tells me that if you really, really want to be safe, I would look at you as a part-time employee. I'm just a little conservative with that, just to be really, really safe. It's going to cost them more money because of payroll taxes, but at the same time, you're going to get Social Security and Medicare out of it.
Okay, so that's a conversation.
Yeah.
It will be too complicated for you if I become an employee. So this requirement about lesson plans, maybe we can leave that off. I've been teaching for 12 years and so on and so forth. And okay, thank you. I got it.
Yeah. Okay. Yeah. You just have to really handle that very carefully because sometimes, they'll take offense at that. So you got to be really politically correct about that.
Oh yeah, thank you.
Sure.
All right. Next question. Any additional tax deductions for home daycares specifically besides the food, snacks, and home office space?
For home daycare, so you're taking care of other people's kids, not take care of your own kids.
Christine?
Yes, I'm taking care. Hello, I'm taking care of other people's kids.
Okay.
I'm a licensed daycare provider, licensed by the Department of Health.
Okay, so I would say because you really have to keep everything clean, all of the cleaners would be tax deductible. Anything that you use in any room where the kids are, any kind of cleaning supplies, anything that you buy that you use for any of the places or spaces that the kids are in, including, if you buy games for the kids to play, then that would be a deduction. If you have to
Okay.
go out and buy, buy sweaters or something for the kids, then that would be a deduction. Really, that's a pretty liberal, that's a kind of a liberal business where you can get away with a lot of things legally. Like things like sweaters for kids and games and stuff like that. You can go out and buy Uno, and it's a tax deductible expense.
Okay.
And then
And like for startup costs, because this is my first year I'm opening the business. Any like startup cost deductions that I should be thinking
Yes,
about?
I didn't put it in here, and I think I'm going to add that. Yeah, startup costs. And if anyone doesn't understand what actual startup costs are, this is money that you spend on the business or relating to the business up to the day that you create your first invoice, or actually up to the day that, if you're on a cash basis, up to the day that you collect money on that very first invoice. And it can be 6 months, it can be a year, it can be 5 years. So I have someone who's been in startup mode for 5 years, and we have meals and travel and all sorts of things that are startup expenses. The first law that's in the IRS books is the first $5,000 that you spend on startup expenses, meaning personal money that you're spending on creating the business or researching the business. If it never happens, So let's say you spend $10,000 on a business idea and it never ever happens. You just give up on it because of whatever reason. The first 5,000 you can deduct as a tax deduction on your personal tax form, on the 1040 tax form. And half of the accountants out there who I talk to don't know that. I try to learn from the best. I learned from my friend Larry, and he knows everything. So, that's one of that. So that's like that's a free $5,000. Um, if you spend 100,000 and you do a build out, you have a storefront, you're doing leasehold improvements, you're spending all of this money. There are thresholds in the amount of money that you spend on startup expenses, where if it's 250,000, then you can take all of the startup expenses over 120 months. And almost like depreciation, we call it amortizing. So you can amortize the startup expenses over 120 months, which is 10 years from the very first day that you start making money. So that's something that you'll get a tax deduction every year for. If it's under, I think it's 50 or 60 or $70,000, then you might have to take it all in one shot the first year. So there's lots of laws that keep on changing about that. That's another reason why you should really, this is the stuff that accountants and CPAs and EAs really, really know, because they deal with that all the time. From the bookkeeping aspect, all startup expenses should be other assets. They are not expenses until you create an invoice or you get paid and you make money. Then you have a profit and loss. Before that, everything, all the startup expenses, you can call it startup expenses, but they are put into your system as an asset, as an other asset. I have a whole video on that one day I'll put on YouTube.
Thank you so much.
Sure.
All right, we have one question from Garrison. Thank you for your time today. It was informative. I started my business at the end of 2020. When are sales taxes due for businesses in New York?
Can I ask you roughly how much you collected in sales tax in 2020?
Garrison, are you able to unmute? Mm,
Sorry
No?
about that.
Oh, okay, there you
Yes, ma'am. Yeah, sorry about that. Nothing.
are. Okay, so what happens is if you start a business and you don't collect any sales tax, automatically you are put on an annual plan.
Okay.
Now, you're supposed to get yourself into the system. So what a lot of accountants do is they go on to New York State or whatever state you're in, and they file a 0.00 tax return, so that you're in the system as a possible sales tax payer.
Gotcha.
And then then you don't have to really worry about it. So you default at being an annual payer. If you collect more than I think it's 600 or 700, then you become every month. Then you become a quarterly payer. And if it's over 2,500, I think it is every month, then you're a monthly payer. But you start off as an annual payer.
Gotcha.
So
Okay.
you don't really have to worry about it. Just, when you start collecting sales tax, put what I am telling, especially with COVID and the way businesses are right now, I am insisting with all of my clients that when they collect sales tax, the next day you take that sales tax out of your checking account and you move it to a sales tax only account. And you can't spend that money. It's not yours.
I've heard that quite a bit.
Yeah, I've been doing that for years. Actually, I was ahead of the curve, but now, yeah, a lot of people are suggesting you do that, so you don't have to worry about that. You don't want the state after you for sales tax. That's the last thing you want.
All right. Well, thank you very much for your time. I appreciate it.
Very, 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 very welcome.
All right, so that concludes our question and answering. So I will turn things over to Damaris at WBC of Bach Network.
So hi, everyone. And once again, thank you so much for joining us today. This recording will be made available in the next 3 to 5 days, in the next 3 to 5 days or less at the bachwbc.org website, bachwbc.org website. Gabriella, if you have a moment, if you can include that in the chat, that'd be dynamite. Again, we will also follow up with an email to you all right now. We will include a survey link. If you can kindly complete the survey, our program is free of service. And in order to continue being free of service, your feedback is important to us. It's information that supports us to deliver our programming and trainings catered to your business development needs. So we request that you please complete that survey. We will also include additional upcoming free trainings in the email follow-up, as well as, again, the recording. Once again, thank you so much for your time. Thank you, Paul Rosenblum with Numerex Services. You're a joy to work with, and we look forward to ongoing partnerships with you as well. And again, to all the registrants, thank you for your time and enjoy the remainder of your day and the beginning of your weekends.
Thank you, Damari. Thank you, Paul. Wonderful presentation.
Thank you. And thank you for having me, all of you.
Thank you, Paul. Thank you, Damaris. This is, Bach is the greatest. Your resources for small businesses, just done. You're a gem.
I'm gonna pay you to say that.
I will say it though. I will say it. So Eliandra West, you got me.
Eliandra, I'm gonna call you in a few moments.
Yes, you will. Okay.
I'm kidding.
Oh, thank you, Damaris.
You're welcome. You're welcome. Have a beautiful remainder of the day, everyone, and please remain in the best of health and safety.
Thank you. Bye-bye.
Same to
Thanks
you.
again.
Thank
Bye-bye.
you.
Thank you. Bye-bye.
Thank you. Bye, Garrison.